Hey, Anthony, how are you doing, man? It's so great to see you.
Doing well, my friend. It's been a while.
It has. We are on the run all the time. Thanks, hospitality industry, for loving us so much. We'll be right back after this.
I'm Anthony. Welcome to No Vacancy Live. That's my friend Glenn.
You're watching the #1 show in hospitality.
Everybody, thanks for tuning in to an actual No Vacancy Live. We've got Anthony Melchiori in the house. I'm Glenn Hausman. Thank you so much for spending time with us today. Anthony, great to see you, buddy.
So either your lighting is really good or my lighting's bad, because do I look like I'm red as a tomato, or is it just my imagination?
You definitely look a little bit redder. For me, I just felt like maybe you've been outside a lot. It is that time of year where we get a lot of outside time. So, I don't know.
Maybe I have.
You've definitely been a lot of time trying out 95. Huh? What?
Huh? Maybe it's my blood pressure.
Yeah. Well, it is very stressful because today we're going to be talking about money and deals and the interest rates and the overall financial environment to help get deals done, the buying, the selling, and all of that of hotels. But I did want to say, Anthony, the hospitality industry is crazy cruising right now. I think this is the first year I've ever had in August where I'm away 3 weeks in a row to different events. Last week is LendingCon. Tomorrow I'm going to the opening of a brand new hotel brand, Live Away Suites in Salt Lake in that extended stay category. And then next week I'll be in Memphis at the Southern Lodging Summit. Pretty wild.
What brand is coming out with that extended stay? Is it a separate brand?
It is. It's a private company, which gets me really excited because I love different entrepreneurs entering the
were you doing a press thing for them, or?
Yeah. I'm gonna help facilitate the opening event, which is gonna be
wow, congratulations. What's the name of the brand?
Live Away Suites in Salt Lake. They're already building or planning to build, already have acquired land, et cetera, for another 8-9 properties before rolling out a franchise strategy behind it.
Wow. Okay, so 6 years from this day, they'll be selling it to IHG.
I'm laughing because you know it's true. All right, let's get right into it today because we've got a great show. I want to welcome Ryan Bosch.
Hey guys,
Arriba Capital. How you doing, man? Great to see you.
Pleasure to be here. Long time listener, first time caller.
I love it. I think that's the first time anyone did that on our show. A long time first time. I love it. That's awesome. So, Ryan, at the top of the show, I mentioned that I was at LendingCon last week, and at LendingCon was great because I had the opportunity to interact with bankers, owners, investors, and a few congressmen as well. So I thought that was really interesting. Before I share some of my observations, how are you envisioning the overall situation that we're in right now when it comes to access to capital, deals getting done, and the overall tenor of the investment community in hospitality?
Yeah, I think it's been an interesting year, right? We've got kind of multiple market forces happening at once. I think on one side, we're seeing a retreat from regional banks. They're tight on liquidity, they're lending less, they're putting out less debt on hotels. Mm-hmm. The other side of the coin is with what's happening in office, on multifamily. We're seeing a lot of lenders actually increase their allocation for hotel debt. So overall, I think there's a lot of capital out there, and we're in a pretty good spot as far as hotel debt's considered.
What were you saying about the real estate, not hotels? What were you saying? I didn't hear that. You were saying that there is money?
Yeah, what I was saying is I think, most lenders, they have asset allocation, right? So let's say they're putting $1 billion out a year. In a lot of cases, 10% of that might be slotted to go to hotel deals. With what's been happening in the office sector, multifamily, we're seeing that allocation increase in a lot of cases. So where lenders might have put out 100 million in hotels a year ago, today they're allocating 200, 300 million for hotels. So we're seeing a lot of capital out there chasing hotels, which has been good for the industry.
Yeah.
But so just to bring it down to brass tacks, if you have $1,000 and you're able to put that into the hotel, how much of that $1,000 can you borrow? Do you have to bring $700 to
Ah,
that 1,000, or how much do you have to bring of that $1,000?
Got it. So you're asking, what are we seeing leverage wise in the markets today?
correct.
I'd say on average,
We have a lot of college kids.
yeah, on average, we're seeing leverage top out at like 65% LTV. So to answer your question directly, it'd be 650,000 on $1 million purchase.
Right. And just to give some reference to people, back in the day when capital was super cheap, before the great, and then also before the Great Recession, you would not have to put in nearly as much money.
Well, actually, Glenn, they would give you 110% in a fruit basket.
Yeah, exactly. Which was really nice because the fruit was tasty and delicious.
I had a deal. I had a deal in the city that literally the owner, right before everything exploded, literally got 100% of his deal financed. Literally.
Wow.
Yeah.
Got 100%.
Good for him.
I think he put in $1 million on a $110 million project. Literally.
Wow.
Right.
Yeah, what we were seeing in the past, right, is I'd say leverage maybe topping out at 70%, in some cases going up to 75%. We've seen about a 10% retreat from that in this higher interest rate environment.
Yeah.
A 10% decrease from that?
Correct.
Oh, okay. So before everything went south, it was about 55%, right? Right before everything got really bad?
I'd say before everything got really bad, again, same metric. So we were seeing like 70 to 75% leverage on most deals. And again, today that's 60, 65%.
Right.
Yeah, because after 2008, everything got a lot tighter.
Yeah.
And that's when I think everybody got smart. And that's why this downturn, as bad as it is, it was more about keeping money on the sidelines than it was about people losing their assets.
Right.
Yeah. So where are we right now with the state of interest rates? I came out of LendingCon last week, clarifying what I went into LendingCon thinking that there will be a reduction of 1/4 to probably a 0.5 percentage point. I based it on my totally unscientific way of anytime before there's a presidential election in September, there's an interest rate drop. So I'm not claiming to be a genius over here, but how are you seeing this potential drop in interest rates, and how will it affect deals in the marketplace?
Yeah, so the last couple of weeks have been a wild time in interest rates, right? If you would have looked about a month and a half ago on what the market was expecting,
right,
it was probably a 50-50 split if we'd see a rate cut in September. Now the market's beyond that. There's for sure going to be a rate cut. The question is it going to be 25 to 50 basis points? And the market's split on that. But overall, the market's projecting that will be down about 100 basis points before the year's over. At the same time last week, after the jobs and unemployment data came out, we saw the treasury rates, the 5-year, the 10-year, drop considerably, almost 40 basis points from where we were a month ago. So
right,
we're starting to see some good relief in interest rates. When there's volatility in the market as there is now, sometimes we see the credit spread widen. So if you're pricing a deal off of a 5-year treasury rate or a 10-year treasury rate, and let's say today's spreads are 300 basis points above that, when there's volatility in the market like there is today, we might see that widen a little bit, but we're still going to see, overall coupon interest rates drop considerably.
Okay, not to bring you to school, but let me bring you to school.
Here we go.
Take what you just said and explain it to a kid that just graduated high school that wants to go into real estate hotel business.
And I'll get started by saying basis points with 100 basis points equals 1%. Right.
Exactly. Yeah.
Right.
Fancy way of saying 1%.
It took me 20 years to figure that out. And I thought everyone was speaking this mystical language,
Yeah, look, I'm in finance. I'm still trying to figure it out on a daily basis.
Listen,
I think in real terms,
I got my PhD. So go ahead. I'm sorry. Go ahead.
Yeah, I think in real terms, we're going to see interest rates drop probably a 0.5 percentage point to a full percentage point by the end of the year. Will make the world of a difference in hotel financing.
I will be surprised if it's a full percentage point. I really will be surprised. I think that's the expectation, but everything that we've expected, they've done the opposite. So I don't. I think if we get to 3/4, I think is going to be shocking to me. I think they're going to do a quarter, and maybe another quarter. But I doubt it. I think it's going to be a half to 3/4. But we'll see. But right now, when people are saying, you hear it, Glenn, you heard it all last week. There's no deals. The money's there, but there's no deals. What does no deals mean? What does it really mean?
That's a great question.
Yeah, look, I think from my side of the lens, I think when we have this elevated interest rate environment, you're underwriting deals, the amount of debt you've got to pay on that property, right, affects cash flow, it affects investor returns, et cetera. So I think, with that coupled with operating costs being elevated from where they were, insurance costs being extremely high from where they were, it's just making deals not pencil. So, people are out there, they're underwriting lots of transactions, and we're just not seeing a move on it because they're not hitting that return profile that they're used to and they're expecting.
Right. So it's almost like some of these deals are like. Sorry, what was that?
I'm sorry, Glenn. What deals are being done?
Where we're seeing the most activity right now is on the smaller check size deals. So I'd say like the sub $20 million loan amount, and that probably equates to like sub $35 million property values. We're still seeing a lot of those properties trade and change hands. That part of the market has, it's not where it was a year ago, but there's still quite a bit of activity. Where we're seeing almost no transaction volume today is on more of the institutional end, right? The large check size transactions. But expectation is that's going to start coming back in the second half of this year.
Yeah, but if you're starting to read, what Home Depot just came out with, and Home Depot said that people are reducing their spend on renovations. If you look at what Star is doing, they're changing their forecast for 2024, 2025. The luxury market is not the higher end market, not the luxury market, but the higher end market seems to be steady going into 2024, 2025. But when you see the mid-class hotels, you're starting to see that drop because people are in so much credit card debt they can't see straight.
Right. Yeah. And we're seeing the same trends on our side on deals that we're underwriting. It seems like the upscale, upper upscale is doing well. The economy segment is, starting to struggle depending on what market you're in.
Yeah, I was really surprised to see that economy hotels are down a little bit this year on all factors, occupancy, rate, transactions, all of that kind of stuff, which is really interesting. Ryan, how much of these sub $20 million deals in percentage wise is the difference between that and the big deals? Because there's so many more smaller deals out there than some of the bigger deals. So are we perhaps just looking at it as, the fewer deals are being done because there are just fewer deals to be done in the category, or there are, historically speaking, fewer transactions in that upper cost end of the market that's happening? Because I look
I think there's fewer transactions happening across the board, right? Whether you're looking on small check size, institutional check sizes, we've just seen a much bigger drop on that institutional check size.
Right.
So yeah, I think overall, and don't quote me on the stat, but I believe we're down like 55% in transaction volume.
Yeah, I'm wondering how much of that is a function of. I just like to play in the thought sandbox for a little bit, because so many huge deals were done, like all of the leasebacks in Vegas and companies like MCR and stuff just scooped up a lot of high value properties during the recession. So I'm just wondering if it's also a function of now everyone's in a holding pattern because all of the low hanging fruit's gone and we haven't gotten to that other point yet. So I don't know.
But this is once the rate drops and you start to see deals. Now let's look at the economy, right? And you look at the economy, everything from college is down. So, those markets may not do as well. And the big cities are still having some troubles with homelessness and crime. You're seeing in some of the big markets, we've overbuilt. So if you look at New York, we built 60% new rooms in the last 12 years. Yeah. So are we going to be rushing to do all these deals?
Yeah, I think it's very dependent on what submarket you're in, right? There's still quite a few submarkets that have strong fundamentals. The one thing on new supply, with construction costs being high, with interest rates being high, we haven't seen a lot of projects break ground, right? So there's a lot of pent up supply in the pipeline on projects that are in the planning stages, or maybe they're even shovel ready, but they've pumped the brakes. So I think that's helping the market overall. I think in a lot of these markets we're not seeing the typical supply growth that we've seen historically, and I'm actually bullish on development. I mean, we do a lot of construction financing, and I think now, if the numbers make sense, it's a good time to get in the ground, because you'll be coming out of the ground in a time with not a lot of other new supply.
Yeah, and that's why I always love a contrarian approach. So let me just put some numbers behind what we just said. According to the most recent numbers by our friends over at Lodging Econometrics, as of July 31st, the U.S. construction pipeline, Dallas is leading with 189 projects. Can you believe that? Then Atlanta has 159 projects out there. But overall, LE forecast for the remainder of 2024 includes the opening of 400 hotels, totally with 444,450 rooms this year, and 650 total for the entire year. The 2024 forecast is a 35% increase over the total number of openings in 23, and it's looking like 2026 and 27 are going to be a lot of openings, which is what you're saying. Yeah.
One, send me that report, please. Number two, will there be a quiz on what you just said?
I hope.
Actually, there's a third question. It's a bonus question. Could you see where we were in 2019? How many deals we were doing right before the pandemic?
I could probably get that information, but it's probably not convenient for me to do that this second. I'll be like,
no, I'm just saying, I didn't know if you had that off the top of your head.
Because I may have it in my database of press releases and stuff like that, but if not, I think our friends.
Typically, on a yearly basis, how many hotels are being built in North America? Typically.
Yeah, that not.
Yeah, I don't have that data off my head. I wish I did.
I got a note this morning that said
somewhere between 700 and 800 new projects every year, in that kind of sweet spot.
Well, I got a note this morning said you two knew everything, so I'm very disappointed.
Oh, God dang it. Well, we don't know everything, but we do know some things. And Ryan, one of the things I'm thinking about is, if the banks aren't going to be lending and people still want to get deals done, where are they filling that capital sources void? Is some of that private money coming into play? What are some other ways?
Yeah, look, I mean, we've seen a lot of alternative capital sources emerging and getting a bigger share of the market than they have in years past, right? So regional banks typically are the lion's share of debt for hotels. We've seen their market share decrease, obviously not lending as much, and an increase in private debt funds, the Peachtrees of the world. Life insurance companies have increased allocations towards hotels. Credit unions have emerged as a pretty active participant in hotel financing. CMBS market is alive and well today and putting out a lot more capital than they have in the last 24 months. So yeah, I think there's a lot of alternative financing solutions out there outside of just regional bank lending. That's kind of filling that void.
Yeah, interestingly enough, one of the conversations I had on stage at LendingCon last week with Congressman Aaron Bean in Florida, the reason why I bring him up is he's part of the SBA type committee. So he said that they're working to make it easier to get funding through that mechanism. I'm like, why is it so difficult? I was able to get more money than I should by just typing in a few numbers on SallyMae.com for my kids' college. Why can't we do something like this for small business? So, hopefully they'll make it.
Yeah, I think the SBA actually has made some strides, right? So they, one of the limiting factors we always see in SBA lending is you've got a limit on the amount you could borrow as a borrower. And there's a lot of work in Congress right now to increase that limit. We've seen some new rules come out, like on SBA 504 loans. They have the Green Initiative. So you'll be able to do more SBA borrowing if you utilize, green infrastructure in your building. So adding solar panels, things like that. So yeah, I mean, look, I think government guaranteed lending's definitely always been a great avenue for hotels with SBA, USDA, and we'll see that continue.
Right. And I would like to stress that the congressman mentioned regional banking several times and underscored the importance, like we all talk about here, having those relationships at those local banks, not just one, but multiple banks. That'll help you get those deals done where others can't, especially if all things are equal out there.
Absolutely.
Yeah. So give us an idea of some common mistakes maybe people make in like loan applications and stuff like that, and how to avoid making those kind of mistakes.
They put your name down as a reference.
Yeah, that's a big mistake.
Yeah, no, look, I think common mistakes we see generally are, one, first and foremost, not putting together a good, clear presentation on the debt, right? I think you got to look at bankers as people. They're reviewing a lot of opportunities. So if you send something to their inbox and it's 45 different attachments that are unorganized and
Right.
no real narrative around it, the odds of them spending the time on that, go down. So I think being able to pitch the project in a clear, concise manner.
Hold on. So watch some Shark Tank and then think about how they present, I think is kind of the vibe you're talking about here, right?
Yeah, no, absolutely. I think another thing that we see commonly is, everyone looks at bankers as we're just reviewing numbers, right? But I think the narrative around those numbers is very important, especially in today's environment. So being able to explain, what are the demand drivers for your property? What's going on in your sub-market? Is there new development happening? Are we seeing increases in demand? And being able to really explain the details of that, I think those are the things that really make or break loan process.
What about talking about will help create job opportunities, will be an engine of good for the community? How do those things work?
Good luck with you. Good luck with that, Glenn.
Yeah, that's why I'm asking. Yeah.
Well, I wouldn't say that that's the most important thing in a lending decision, but I think it is important in some aspects, right? I'd say especially if you're doing government guaranteed lending, like USDA, SBA lending. Part of the guidelines is they want to see that job creation.
Right.
I've been in meetings with really smart people who graduate top of their class at the Ivy League schools, and they know every parcel of land. They know every building, the tenants in the building. They know contracts 5 years from now, who's moving into the city. They know which area is going to be gentrified. They know which area is going backwards. They are completely, and even at that point, at that level, with every single thing that you could imagine, things you didn't even know, even if you were the banker in the region, it's still very, very difficult. So to your point, Ryan, when you go in, it's got to be a lot of fact and a little sizzle. But if you don't have the fact, it doesn't matter. And if you don't have the sizzle or the facts, and like you said, you sent something, even a resume. I had a resume the other day, and it was 3 pages. And the only reason I read it is because the person came highly recommended, and I actually spoke to the person. He's great, but typically that resume is not even getting read. So it's got to be very succinct, and it's like they call me Mr. Succinct, Glenn, just so you know. It's got to be very succinct, and it's
playing that right now. Yeah,
but it's got to be. I always say your job is to give information to people that they didn't know. Because a lot of people sitting in those rooms know 90% of the information.
No, look, absolutely. And I think one thing people forget all the time in lens of lending is, everyone expects it just to be a quick underwriting box, right? Where it does financial metrics check the box, but which is true to a degree, but at the end of the day, it's still a human decision on lending, right? So your loan application is going to go in front of a board of 5 or 6 people in a room. They're going to go through the credit memo and make the call, do they want to do this loan or not? So I think the narrative and experience of you as an operator, all those things definitely factor in.
Right. And I would also say there are certain types of properties that are more viable these days. For example, something like 1/3 of the new construction pipeline is in the ever-growing extended stay market. Consumers are loving it. Owners are finding it to be great operations, and you can deliver more cash. So if you go in that way, you might be more likely to get approved. Anthony, sorry.
Is it a trend or a fad?
It's definitely a trend. That's a little callback to our high-tech speech.
Is it going to become maybe not the redhead stepchild it was 7 years ago, but is it going to become less sexy 5 years from now, especially if you have that middle economy sector struggling? And I'm just wondering if I'm an investor in that. I love it regardless of the economy, simply because of the way it operates. Because when you have extended stay, you can still. When I ran the Staybridge Suites in Times Square, we got higher rates than most of our 4-star hotels. So depending on the market, I don't think it matters. But Ryan, do you think it'll stay sexy for the foreseeable future, or you think it's going to start?
I'm with you in a sense that, look, I love the extended stay segment. I think overall it's a good segment to be in. My one concern right now, to your point, is we're seeing a lot of new supply coming on the economy side of extended stay. And that's the piece of the market right now that's struggling. So how that plays out over the next 24 months is a little concerning to me, just seeing how much new supply while we're seeing kind of a retreat in ADR growth and overall market.
In the extended stay, you have less sophisticated salespeople. I'm not talking about the franchise. I'm not talking about the brands. But if you're an operator, typically those salespeople, maybe you don't have as many. Maybe your staff is not as seasoned. So I think that those hotels, unless you have a seasoned staff, and I don't want to piss anybody off, so don't send me an email about that, what I just said. I'm just saying in general, that you have less FTEs and less salespeople to those extended stay properties. And a lot of times they need the heavy lifting.
Yeah. And if you want to learn more about sales and extended stay, check out my episode I did with Jimmy Taylor, VP of IHG for ESLA's Icons and Experts.
When did you interview Jimmy Taylor without me?
It's for a different show that I'm doing.
There's very few people you can interview without me.
I know. Sorry, this is through the Extended Stay Lodging Association. Check out my friends there at esla.org. We got to get Jimmy on this show for sure.
He's one person I know longer than you know him.
Yes, and you clearly introduced me to him. Ryan, help get us back on the rails over here. So one of the things I'm seeing, I love the extended stay model, but I'm also thinking smart investors are starting to think about that next big thing. We had on Dan Lesser, who was saying 10 years from now, San Francisco, people who get in are going to think it's a great deal. I'm a big believer in alternative accommodations, meaning ones that focus more on incorporating outside and inside and those kinds of elements. How do you see lending responding to some of the new trends that might be coming and some of the trends that have been around for a long time?
Yeah, look, I think one of the first things that comes to mind is the emergence of soft brands, right? Overall, we're seeing extremely good performance in that segment. I'm seeing a lot of development activity in that segment, and I'm seeing good lending appetite. So I think that's an exciting piece. We just recently did a recapitalization for an experiential hospitality brand that was, outdoor focused and, drive to destination markets that are up in the mountains near ski resorts, things like that. And, we got a lot of interest on the lender side on that deal. So I think a lot of these, upstart concepts are starting to prove out, and they're hitting, a point of scale where there's enough of them, and the concept's proven, the demand's there, and the lending markets take note of that. So I think there's a lot of interesting things happening in hospitality.
Yeah. Also, I want to make an observation that plays into what you're saying and one of the comments from earlier. Like brands like My Place, which is still in the economy extended stay segment, I think they're skirting some of the larger issues because they're going into locations where major hotel brands have never been before, that already have this built-in need for supply. So it's not, so whenever we talk about stuff, everyone has to remember we're talking about it on a national or a North American level, and each market has different opportunities. Like what you're talking about, Ryan, the drive-to markets, Appalachia seems to be exploding right now. People are moving there. people are vacationing there, and it's creating opportunities that might belie what the overall statistics would lead you to believe.
No, look, absolutely. And I think that's something everyone always has to remember when they look at these macro statistics is, you know, if we're showing, you know, a 5% growth in RevPAR over the next 12 months, I'm just pulling a number out.
I totally get it.
You know, you might look at one submarket and it's going to be down 3% over the next 12 months to another submarket that's going to be up 10%. I think that's, you know, that's part of the key of being a good hospitality investor or a lender is finding those markets.
So let me ask you a question, going off the rails again, because that's what I enjoy doing on the show. It's called Off the Rails with Anthony. Is when you're in a deal and you may have a franchise, you have the owner, maybe you have the management company, and you see an owner who's relatively new. Maybe they've made their money in a different market, but you know as well as I know, the hotel industry is very specific, and if you know it, you can do extremely well, better in the hotel business than in most segments. However, have you ever been in a meeting where you just know that poor SOB is going to get taken to the cleaners if they don't have an outside consultant, an outside person, not a brand, not a management company, not a bank, but somebody tapping on the shoulder said, don't listen to them, do this, do that. Because what I'm seeing, and that everyone in the room is smart. Everyone, the brand, they know their stuff. The banker, the management company, and especially since we've been working through the last 5 years, everybody is extremely educated in this market. However, what's going on in the market. However, with that said, whether it be employees, whether it be buying things, whatever it is, with that said, but never has it ever been so tight where everyone has got to do what's right for them. So my question is, which I think I asked in the first sentence, but I like talking, do you advise them to get an advisor?
Absolutely, especially if you're green to the space, you know, the hotel world is complicated. It's probably the most complicated real estate asset to finance because you're dealing with an operating business, you're dealing with a franchise in many cases. There's just so many other factors going on versus just collecting rents like you would on a multifamily building. But yeah, look, I think having outside counsel, whether that's, you know, asset management, capital advisory like we do, whatever it may be, is paramount. And I think, look, a big part of hotel lending that every lender is looking for is experience, right? They want the guys that have been there and done that. So when you don't have that, how do you get around that? You bring in a team that does, right? And that gives lenders comfortability, that gives your investors comfortability. You know, we're doing a large scale development right now with a first time hotel developer that's north of $100 million. And what makes that work, or what makes that deal work outside of the fact that he's a very sophisticated, you know, individual, is he's brought in a world-class team to help him on every facet, right?
Yeah.
And that gets rid of any, you know, insecurity or anxiety a lender might have about, you know, this being his first rodeo.
Right. And when you have a sophisticated human being, I don't care what market you're in, if you've never been in hotels, but you're sophisticated, you're gonna hire the right people, you're gonna do the right thing. I've seen where people made their money elsewhere and it's more of a vanity thing. It's more of, you know, I want that Rolls Royce. Oh, by the way, I got the Rolls Royce, I got the plane, now I need a boutique hotel in Miami.
It sounds like most Four Seasons owners.
Yeah, I'm sure, Ryan, I'm sure you've seen those deals.
Yeah, look, we've definitely run into that, right? And in those cases, there's a small odds that sometimes they win, right? And the deal goes great. In most cases, not the case, and we end up coming in later on.
So another question, typically, when a deal gets done to the deal getting built and opened, what percentage of deals actually get to the opening bell?
Oh man, I'd say, I don't know that stat offhand. I'd say it's probably pretty close. It's probably pretty, in my experience on every deal we've done, it's been 100%, right? We've gotten to the finish line. Now, what I could tell you is I think most deals will get to the finish line. It's the path that it takes to get there, right? I think we see a lot in development.
And the names may change by the end of it.
The names might change by the end of it. You know, we see just about every development deal ends up costing more than your budget was at the outset of when we closed a loan. Timeline's always longer than expected. I mean, these are the beauties of developing, right?
Yep.
But on the overall, I mean, we see just about every project make it to the finish line.
I had a contract out of Florida, and he said, "Hey, I got a new boat." I said, "I know the name of it." He goes, "What? You know the name of my boat?" I said, "Yeah, it's called Change Order."
That's hysterical. Ryan, how can we learn more about you at Arriba?
Yeah, look, I'd say check us out online. You can find me on LinkedIn. Our website's www.arribacapital.com. Reach out if you want to talk hotel finance. That's what we're here for.
Beautiful.
Yeah, and Ryan, if you can send your cell and stuff to the chat, so Suzanne can send it to my phone, so I can have you on my phone.
Yeah, absolutely.
All right, Ryan, thank you, friend. Really appreciate you being
Thanks
here.
so much, guys. It was a pleasure.
Thank you. That was fun. That was one of the more entertaining conversations I've had when it comes to financing.
Yeah, I can tell you, you're on fire lately. It must be all these things you're doing. Your energy is really high.
I'm spending all my energy today so I can take a nap on that flight out to Salt Lake later today.
Salt Lake. You might as well go to Vegas.
I know. Well, I'll be back there soon enough. But while I'm flying out to Salt Lake, I'm going to be listening to my own audio podcasts. Why not? I get them wherever I get any of my shows. And also, if you want to watch us on LinkedIn, Facebook, Instagram, novacancynews.com. And of course, all shows are there in perpetuity. Anthony, it was great seeing you today.
When you tell people, the other day I told somebody, and I said, "Oh, by the way, I do the podcast, and we have over 800 podcasts." And what do most people say when you say you have over 800?
They kind of look at me and go, "Really?"
They all look at you and go, "What?"
Yeah, but they all do some sort of head neck tick or something like that. Yeah, all right. Yeah, my mom doesn't believe it either, but that's okay as long as you out there are joining us and helping.
Well, your mom didn't believe you were going to graduate high school, and here you are.
That's true. Although I almost had a little trouble with college. Thankfully, I passed that last Spanish exam and then promptly forgot it.
Hey, don't go to your last English final with a moose head label on your head, because that gets you 6 more months in the prison.
All right. We'll see you guys later. No live show tomorrow. Live show on Thursday. We'll see you soon. Take care.
And just so you know, he's not telling the audience that. He's telling me.
Yes, exactly.